Good weekend, all. Ira Epstein, and here we are with your weekend edition of your metal market wrap-up. And this wrap-up is for Friday. We're at the 8th of September already, 2023. So as we look at the markets, you know, it's interesting. I was just watching national news. They have to push back football times that they're starting games in Texas. The heat is so extreme. I have a good friend that lives, I have two good friends, one that lives in San Antonio, another in Houston, and they have just told me how brutal the weather is. I mean, you can't even go in the pools. They're so hot. It's like going into a sauna. There's nothing to refresh yourself with. And some of these are what? Nearly 2 months, day after day, 100 degrees, if you can believe it. The weather will break. It always does, but you're not there. And I just mentioned it because how do you play football 100 degrees at night with humidity? Yeah. These kids, I hope they don't get hurt. The coaches, I hope they take care of them. So this is going to be an interesting week. We get the other parts of the puzzle that I've been leading up to. They are the core PPI, the core CPI, and the last one will be the retail sales. And then the week after this, we get the FOMC meeting. I think it's on 19th and 20th, and on the 20th, the Fed will tell us what they're doing. The market overwhelmingly thinks the Fed is going to sit pat. I can understand that argument, not even begin to argue with it unless this last part of the puzzle comes in very strong. If you get strong PPI, strong CPI, you got a problem. Then the Fed's got to make a decision. Why not go for it right now? The economy's humming. Labor, if you're looking at jobless claims and the like, you're back to the lows of January, February of this year. Why not make your move and do it? The fear is they don't want to tip the economy over. They're happy with how things are going, some say. Again, I'm going to repeat. They need this last piece of data. That core CPI is going up again. They got to attack it. Bank after bank around the world wants to back off now and go to a neutral stance. That's what you keep hearing. It's what the traders are expecting. You have the CME Fed Watch page if you go look. Now, before we go into the charts, we're going to be starting our webinars again. Now, these are live webinars. They start promptly at 12:30 p.m. Central Time. In order to get in, you need the link. You need your password to come in. You've got to register. Registration is limited. In other words, I only have so many seats in these webinars. You can ask questions on spiders, ETFs, the stock market, futures. Anyone that's going to ask me about the spiders, ETF stocks, folks, do me a favor. Not only bring your questions, write them to me. When you sign up, you will get from us, after you've registered, an email will come in a few minutes right after that. And in it, there's an area you click and write the question. It comes direct to me. I prepare the chart so that when we have the 20 minutes, we're running through it. I do not record these charts and post them. I do record them for regulatory purposes. I do not post them because it's a question and answer. It is not about me doing a presentation. I do those in my special reports. This is for you and me. We get it. We answer the question as best we can, and away we go. I'm the only one that talks, but I will repeat your question for the whole audience to hear, and everybody can do that. 20 minutes, you make your time for it. Sorry, if you can't make your time, then you can't do it, okay? That's the only time I have available, and it's this Thursday, 12:30 p.m. Move your cursor to the top up here. If you didn't receive my invite this morning, means you're not on my mailing list or we've taken you off the list. Move it up here, register. From that registration, we'll have everything we need for you, and that's it. So you register, you'll get the email, and I'll see you at 12:30 come Thursday. Should be a lot of fun. All right, so let's go to the markets and take a look as we normally do. And this is all about weekly charts, not daily. So in the gold market, the bias is certainly up. Let me define bias. When the market is over, be it the 18-month moving average of close, and this is the monthly, or the weekly, if it were over it, that would be up. The weekly is down, the monthly is up, the bigger picture. This says you got to go down to 1854, and you don't have to fall there, but you have to get under that number right now in order to turn the bias down. Let's get back to the weekly. The weekly went up, and as I told you, I was questioning on this rally if you wouldn't fail at that 18-week. As it turns out, And the videos are there. Go back a couple of Fridays, you'll see it did end up failing right there. So where are we now? That becomes the rough question in it. The trend, as I define trend, is down. Let me define it for you. This is called a swing line. The line is drawn to either a day's high or low. The rules that I've set up look at 5 variables: inside trading day, higher high day, lower low day, outside day up, outside day down. One of those ways. And the rules kick in and these lines draw. Why? All we ever hear from analysts is, oh, the market's making higher highs, higher lows. It's in a bull trend, or the opposite going on. Or you could have no trend. You got a higher high and a lower low in some manner, or the flip-flop and you're not going anywhere. This is trending down. Where's the resistance? I think it's crystal clear. It's the 18-week moving average of closes. I think the pros are selling into a basis this. Why? You're under that. The trend is down. The resistance is 1945.20. The risk, though, would have to be last week, one tick over that number. Now, that high of last week was right here. That high was 1961.10. Is that the kind of dollar risk you want? That's what you got to ask yourself. If it is, fine. But that is a $1,600 risk on a full-size contract. If you trade the very small contracts, you can mitigate that. What about profit objectives? Well, certainly the closest moving average under the market is the 100-week at 1851. And lo and behold, where's the Bollinger Band with that number? The Bollinger Band is right through here at 1886. So the real objective in the market, if it's going to continue down, is the closest of those numbers first. And you don't really have to go off and beyond the Bollinger Band. Why? You only go out of it and close outside of the Bollinger Band. Let me just step back here. 5% of the time. Do you want to play that this is the time it's going to go? When time and time again, it just comes and snaps? You do that. I wouldn't. That is also not something that I would come in and tell clients go short. You go short here, where are you wrong? Up here? I mean, there's a cry uncle part. I used to early in my career go, oh, look, I know it's going to fall back. I'll go short. I didn't have enough money to hang on. And that's the reality of trading. So understand how those things work. So what would get the market bullish? Because I just told you the bear side. We got to flip this. Take out that 1961, you could end up with higher lows, higher highs, and you open the door up for wherever the Bollinger Band is. Now, it won't be 2004. It'll be a lower number because when we reopen on Sunday night, that number will drop the way the math's going to work. But giving you an idea what could be that part. When we take a look at momentum, you had been oversold, and now, as long as neither number is under 30, you're not oversold. So here's where you're at. You have a market that's in a downtrend, more downsides possible. To get down to this number, you're going to get oversold again. That's a dilemma you have in trying to sell a break in the market versus trying to sell it on that rally if it goes back to that key number. In the gold-silver ratio, as the silver crossed the 82 level, it fell apart. Because this tells you how many ounces of what? Silver you need to get 1 ounce of gold. The higher the number, the more ounces you need, the less silver is worth. That's the way to look at it. And if you look at silver, it is one ugly chart. You have a lower low. I really could have moved this arrow right here. I think that's a higher high there, just about 100% positive. But it's not a trend. You have a higher high, lower low. Nothing that I see there. Copper's in a downtrend. Lower highs, lower lows. The trend just kicked in now. And what I hate about it is it kicked in right at a major support area. I hate a trade like this. And I rarely take them. I don't tell my clients to do that. When I say take them, that's what I'm telling my paid subscribers. Why would you sell the first challenge of a 200-day average? It hasn't really been a money-making proposition all the way through. So what's going to make it better this time? I'll let somebody else figure that one out. In the platinum market, I thought we would fail. Again, go to last week's trades against the combination of the 100, the 18-week average of closes, and boom, you did. And now the question is, are we going to the Bollinger Band? You're not trending. You have a higher high and lower and low pattern. And last, the dollar index. As bullish as everybody is, I'd be telling you, hey, at 105.36 or wherever the Bollinger Band comes in Sunday night, there'll be a new number. I think you got to pull some money off the table against that. You're overbought on a weekly basis and coming up to key resistance. I know it's going to be unpopular. Why? Oh, everybody's going, well, the dollar's going. It's going to 110. It's going wherever. It's infinity. Just when you think that's the case, they come and get you. You know that that's how it works. But we'll talk about all this. We'll talk about this and more in the What's Up Live webinar. Again, move your cursor up here. You can register that way. Let us know if you have any issues. You can always call my staff. They'll help you at 866-973-2077, but they won't be there this weekend. They'll be there Monday morning. You take care.